What was the transaction market really like in 2025, and what's in store for 2026? Are we going to see a rash of distressed assets hit the market in self-storage? Maybe more importantly, what's going to happen with interest rates? Well, we've got three of the best and brightest joining us today for the Storage Unlocked Broker Roundtable. I'm your host, Thaddeus Campbell, Director of Business Development and Strategic Branding at S3 Partners. 30 plus years, over 300 ground up developments across boat and RV, self-storage, and small bay industrial flex. If you've got a piece of raw land and need help from entitlements all the way through handing over the keys, we can help make your dream come alive. So excited today to be joined. Nathan Coe, Frank DiSalvo, Kevin Bledsoe. First and foremost, guys, thanks so much for taking time out of your busy schedule to come and join us for the roundtable.
Thanks for having us.
Guys, really appreciate it. I'm going to start off. I'm going to go right around the room. I'm going to ask a quick question, one-word answer. Nathan Coe, I'm going to defer to you as the broker with maybe the longest track record in storage. We're going to start out with you. One word to describe 2025 from a brokerage seat. What would it be?
Better.
Love it. Frank DiSalvo.
Stressful.
Love it. Kevin Bledsoe.
Hopeful.
All right. We're going to do one more question. What changed most in 2025? I'm going to give it three options. Feel free to throw out another one, but would you say buyer psychology, seller expectations, or did lending behavior have something to do with what changed in 2025? Frank, I'm going to start with you this time.
I would say seller expectations.
Kevin Bledsoe.
I agree with Frank.
All right.
Same.
And love it. Seller expectations change. Hey, I'm going to start with you, Nathan. I'm going to go back to you again. What changed with seller expectations? What was it that happened that made an impact on the market?
Yeah, thanks, Thaddeus. And I don't think it changed drastically just compared to bank debt and the others, which didn't change. I think that we saw the seller that was hopeful would get somewhere back to the crazy highs we got a few years ago. I started to realize that was maybe anomaly years. So I think it wasn't necessarily changed in a huge way or maybe as much as it needed, but compared to some other sentiments, it changed more than the rest, in my opinion.
Kevin, anything to add to that?
Yeah, no, I agree with Nathan. I mean, it was really, I think, coming out of 22, right? Just super, super highs. And then I think sellers just had unrealistic expectations. Like it just wasn't going to go on forever. And I think over the last few years, they've gotten a little bit of reality has sort of hit them that, hey, this is not 2022 anymore, or 21 or 20 anymore. We're really kind of back to like maybe closer to like maybe 2015, I think, is where we're kind of at on valuations again. But they're improving, that's for sure.
Frank DiSalvo, talk to me about the type of deals that got done. What was the dynamics of things that actually crossed the finish line in 2025 versus deals that you weren't able to find a buyer for?
I think where we had the biggest challenges in 2025 were pro forma underwritten deals, heavy value add stuff that hadn't been performing over the past couple of years. And I think even the beginning of the year, we were able to get some of those deals across the finish line. And one of the things we noticed midway through the year is a lot of these buyers are looking at facilities that they've owned that aren't performing. And they're like, why would I bail somebody else out if they haven't been able to turn this thing around? So I would say about halfway through the year, and I would, say kind of going into this next year here, really heavy emphasis on in-place yield, things that are really working. I would say going back to the bread and butter of what has always worked in self-storage, it's the value add through mom and pop, buying that and, making that more efficient versus buying something that's like quote unquote value add, but somebody, a syndicator or somebody else had already purchased that in the past and they hadn't been able to execute. Those deals were really, really tough. The true mom and pop deals, the stabilized deals, those are the ones we were getting across the finish line in 2025. And I think that's what we'll continue to see, at least so far in 2026.
Nathan Coe, anything to add to that?
Yeah, I agree with both. I think what a common sort of summarization I have been saying is I think buyers are still being like relatively aggressive just from a pure cap rate perspective compared to where debt is. But on the opposite, very conservative on the underwriting, rent growth, pro forma, similar to what Frank talked about. A lot of it's stemming back to how their own portfolio is performing. And even if it's not bad, a lot of people aren't killing it or seeing that high single digits, double digits income rent growth that everyone saw a few years ago. So they're they're factoring that into their underwriting. And yeah, I agree with the sentiments there.
I'm going to come to you with this one, Kevin. It's something that's fascinated me over the last year. You know, Frank and Nathan both talking about mom and pop and that still being an area. Do we still have enough of those assets left in the industry? It seems like consolidation's happening so fast. Kevin Bledsoe, is there enough of those type of properties left to really keep the transaction market fueled? Or are we going to start to see it be more institutionalized?
Yeah, I mean, that's a good question. There's definitely been consolidation since I started in this business in 2005. The consolidation has been pretty drastic compared to what it was coming up to that period of time. But there are still a lot of deals out there. There's still a lot of single property owners out there, and there's still a lot of low-hanging fruit for investors to come in and purchase properties and put the standard things in, like, revenue management and tenant insurance and dynamic pricing and things like that. So, I mean, and I'm sure Nathan and Frank would say the same thing. We look at more P&Ls than probably most people in the country, right? Like, we're looking at financials all day that most people never see. And when we look at them, I know when I look at them personally, I can dissect those pretty quickly and figure out where the opportunity is at. And there's still a lot of opportunities in many of these deals. A lot of people still haven't implemented enough technology that has come into the industry over the last 10 years. So there's definitely a tremendous amount of opportunity out there. We get those questions every day.
Frank DiSalvo, I'm going to come to you with this one. Who is the buyer now, and has it changed in the time you've been in brokerage?
I think it really depends on the type of deal. Going back to something that Nathan was commenting on earlier, where there's still a very aggressive cap rate being paid for, compared to where the debt is right now. There's a lot of private equity groups. We were both out in Aspen a few weeks ago, meeting with a lot of these groups. There's a lot of private equity groups, REITs that have a lot of capital. It's just their buy box is consolidated quite a bit to major markets and stabilized deals, not across the board, but for the most part, if I were to try and summarize. So I think, when you have a larger deal that's stabilized or, that can offer a yield cash flowing investment day one, you still have most of the private equity groups at the table. Where we have, and we do a good amount of this volume, sub $5 million deals or, what you would call sub institutional size deals, that buyer pool has gotten much, much smaller. A lot of the larger groups have gotten out of that. Now we're mostly dealing with local owner operators. We're dealing with first-time storage buyers, mastermind students, stuff like that. So I think there's actually a lot of opportunity to find a much higher yield in those smaller deals. We're selling a lot of those deals for very high cap rates compared to where they used to be. And then on the flip side of it, if it's a larger institutional deal in a top 25 or, top 50, top 75, depending on the group MSA, all the private equity groups are still, for the most part, at the table, and they're still deploying. They have a lot of money to deploy this year, which is why I think there's a lot of reason for optimism as we go into 2026.
Nathan Coe, anything to add to that before I ask the next question?
No, I agree. And going back to Kevin's comments, I agree with that too. It's compared to other asset classes, I think it's not fragmented in a good way. And some of the big portfolios that have been done have been either from one REIT to another, or some of the REITs are starting to sell, which, like for example, I sold a couple assets for one of the public REITs, and one buyer owned one property, the other buyer owned four. So reverse fragmentation there. Not that that's happened on a macro level, but we still have a very compared to other asset classes from my perspective, we have a pretty fragmented industry in a good way. And I think that's what's great about storage. I think also their storage is challenging for a lot of reasons. It's hard to underwrite, but at the end of the day, there's very little distress compared to other asset classes. There's still a lot of bright spots that people coming from other asset classes are seeing. So I think that's why we're continuing to get new private equity, new single buyers into our space. And I think we'll continue to see that from a buyer perspective.
I'm going to continue down this road a little bit. You brought up distressed assets, and I was at the investment forum in New York City and started to hear rumblings that kind of extension of IO periods or the extension of a balloon payment, that banks are finally starting to say, hey, it's time to pay this loan off. Is that something you're seeing on the transaction market where we're starting to see some more distressed assets hit the market? Nathan, that's for you again.
I've not started to see that outside of maybe the one-offs, but very few and far between. But no, I've not started to see that on a norm perspective.
Kevin, I'm going to give you a shot at that one too.
I mean, Nathan's right. I'm not seeing it either. I mean, there are occasionally like one or onesie twosies here or there that maybe there is a little bit of distress, and I've worked with a couple of them, but we're just finding creative ways to, whether that's split the partnership up, right, and sell off 40% of the property to bring an investor in. That's more of what we're doing than actually having properties being, taken back by the.
Frank, I'm going to come back to you for a second. You started talking about cap rates and third quarter earnings call, right? Public Storage, they're buying at a 5.25 cap. What is allowing in storage folks to be paying cap rates that are significantly under what typical lending rates are right now?
I think it's a consolidation of most of the groups going after the same thing at the same time. And we've seen this a few times. I've heard other brokers mention this, where if you have a stabilized cash flowing asset in a good market, you're getting 20 plus offers, because a lot of these groups are taking the same directive from their capital and saying, all right, I need to be in a larger market. And I think it's almost creating a synthesized premium right now because of how many people are going after the exact same thing. And in reality, there's not a lot of assets out there that check these boxes. So when you see one hit the market or you see one come up, right, when you say top 25 MSAs and you're looking at 70,000 storage facilities, like how many of those are in the top 25 MSAs that aren't already owned by a major private equity group or a REIT or, whatever it might be? Yeah, there's still a lot of mom and pops, but there's a lot less in Chicago or Atlanta or New York than there was 10 years ago. You go to a small market in Alabama, there hasn't been the same level of consolidation. So I think that's really what's driving these 5 cap offers on primary market stabilized deals, especially ones that are, true mom and pops. But I'm even seeing them on, some REIT managed deals around that same cap rate, if not a little bit higher. But that's, it's funny you mentioned 5.25. That's kind of where my head would go for that type of deal. And I think that's what's causing it.
We were obviously seeing, and Nathan, I'm going to come back to you. We were seeing, 4s. I even heard of a major market under 3 cap back in 21, 22. Do we see these cap rates coming down again? Are they going to go down from 5.25? Prognostication had as we head into 2026. Do we stay steady? Do we see a decline back to where they were a couple years ago? Do we see them start going the other direction?
I believe this year will be steady, and if anything, maybe a very small decline in a lower cap rate way, but mostly similar cap rate environment that we've been in for some time.
Kevin, anything to add to that?
Yeah, I mean, the cap rates are definitely compressed compared to where interest rates are at, right? But I think to Frank's point, Frank made the point that there is competition, right? And people do want to be in self-storage, right? Like, this is just where they want to be. It's a better asset. I don't want to say if it's better. I shouldn't disparage other asset classes. That's not the right thing to do. But I do think that self-storage is a heck of a lot easier to run than multifamily or retail, right? It's just an easier asset to run. You don't have to, there's no toilets, there's no things like that. So it's definitely attracting investors. And it's not, it's not this thing that you can't get a loan on anymore. Like, when I started in 2005, it was very difficult. But now it's a mainstream asset that everybody wants. And just the fact that these leases are month-to-month leases, like, that really helps move the revenue management button a lot and helps build equity very quickly.
Frank, I'm going to come back to you. I'm fascinated by this, right? Because within the industry for the last few years, we've been talking about headwinds constantly, the challenges we're facing as an industry, all the things that are going wrong. And yet I go to the investment forum, I'm out in Snowmass for the ski workshop, and you're also hearing massive amounts of private equity still wanting to get into the industry. What is it about self-storage, even when internally we're talking about challenges, that's making this money still want to come into the industry?
I think, there's 2 things. I think the money came into the industry, so now it's here. And I think some of that was driven by the distress in different asset classes during COVID. So I think to one effect, there's, once you're in, you're kind of in for a penny, in for a pound. I see a lot of that occurring. But I do think, to Nathan's point earlier, like, this industry is so fragmented still. I started in storage. I've been in storage for as long as these guys. I started in 2017 on the acquisition side, and I was calling mom and pops. And I looked through the database that I was calling in the Carolinas and the Southeast. A lot of it has been bought, but a lot of it has not been bought yet. So I look at that and I still see a lot of opportunity. And I think a lot of major other groups see opportunity, and they're seeing it, compared to some of the distress you're seeing in office, how big the buyer pool is in retail and multi, and how competitive that is. I think a lot of people look at storage now that they understand it and they've wrapped their head around the management, which I think is going through some growing pains just on a macro level across the industry. But everybody's taking time to understand it. Everybody's taking time to understand appropriate rent growth projections and all that. And now they still see it as a asset class that really hasn't had nearly as much consolidation as some of these other larger ones. So I think that's where you're seeing a lot of the equity continue to pour in, or wide rather.
Nathan or Kevin, anything to add to that?
I agree. And I think it's challenging. I think gone are the days that people from others maybe more sophisticated asset classes come in and have these huge lifts on the value side, but I think there's still a lot of upside. I think we're just scratching the surface in many ways on the technology side. So I think there's still a lot of optimism and perceived upside in different areas like that. So I'm not surprised that we're still attracting every asset class is tough right now, and between where there's still a lot of fragmentation, a lot of upside, and very little distress, I think it's not surprising we're attracting interest from big and small groups all over.
Nathan, I'm going to keep with you for a second. Areas of the country that you're seeing that are more interesting to investors, performing better? Are there pockets that are standing out, or are you seeing things generally even across the board?
Yeah, I think the easy, obvious answer is where everyone flooded to the Sunbelt, all these growth markets where everyone wanted to be, rightfully so. The population growth, warmer weather, et cetera, is where there's just so much overbuilding, and there's been overdevelopment everywhere, relatively, but it's just in some Sunbelt markets is astronomical. So I think Midwest, Northeast, where there wasn't that level of overbuilding and or high barrier to entry, I think are the ones that are doing relatively well in comparison. And I think some buyers are seeing that. And other than that, I think there's opportunities, but also headwinds in any market.
Kevin, I'm going to let you follow up on that. I don't want to go to Frank right now because he and his partner David sort of go Carolina down to Florida as their wheelhouse. You're mid-Atlantic and north. Kevin, tell me how you feel about that.
Yeah, you know, what Nathan said is right, and it's actually kind of funny because I'm sure Frank and Nathan have seen the same thing. Like probably like 6-7 years ago, everyone you talked to, they were saying, "Oh, we have to buy in the Southeast, we have to buy in the Southwest." And like you know, selling properties in Mid-Atlantic and Northeast, like yes, we were still moving them, but it just got to be like so tiresome to hear because every conversation you had is like, "Well, we want to buy like in the Southeast or Southwest." I'm like, "Well, yeah, so do you and 150,000 other buyers, but we have some really great properties," and that sort of has changed now. And now I'm not having those conversations as much as like, "Oh, we have to be in the Southeast or the Southwest." They are entertaining assets in the Mid-Atlantic and the Northeast as well.
Frank, I'm going to come to you with a follow-up question just to dive in a little bit more on that Sunbelt Southeast section of the country. Obviously, you and your partner both living in that area. Is it kind of can you paint a general swath from the Carolinas down to Florida, or are there markets that are still performing really well where your transactions are easier? Give me a little bit of in-depth on what's going on in that whole segment.
Yeah, I think it's interesting because I think one of the things you have to talk about is where we were coming from and where like sellers' expectations or developers' expectations were on an exit price or what they thought they were going to get for projected rent, and the reality which has occurred. And I think it kind of parallels, like if you look at the housing market and what's occurred in Austin or Nashville over the past year or so, or past couple of years, you can kind of see the same thing. Like the value has gone down so much. So it's almost like where we were coming from versus where we are now. And I think that's what's interesting about what I found in the Midwest, and these guys are more experienced in these markets, but in the Midwest, you have a lower basis, which I think is attractive to a lot of buyers. And in the Northeast, you have higher rents that are protected with less development. It's a higher barrier to entry. To that point, I think the markets in the Southeast that have higher barriers to entry, which are not a lot of them, because historically the Southeast hasn't been like really, really targeted up until that, big push a couple of years ago. But if you look at like certain areas of the coast, like a Charleston, that type of market where it's tougher to get approvals and you have to deal with wetlands delineations. We've had a lot of success in like Asheville and Boone in the Carolinas because the topography is really challenging there. The rents have stayed really high. You also have tighter municipalities. I mean, you kind of want to look for municipalities that don't want storage. It's a double-edged sword, right? So if you're going to develop there, you want to make sure that if you're going to go through all the work, nobody else can develop there. And I think kind of the shiny penny that a lot of people have reached for and they've realized that it's not really what they were hoping it was going to be, is a low barrier to entry, being able to put up storage very quickly, because a lot of people are seeing the same thing. So we've seen Florida as a great example. It's been really challenging with the new insurance premiums in Florida that have occurred over the past couple of years. the new tax assessments that have occurred in Florida. And then on top of that, the rent in some markets dropping, 50% of what people were projecting it to be. That's been challenging. Now, Franklin Street does a lot of stuff on the insurance side. I'm on the investment sales, but we have an insurance team that specializes in Florida, and we're expecting those premiums to go down. So we're expecting the market to open back up a little bit. But yeah, the Southeast, it's been tough. There's a lot of new developments either in the pipeline or, that have recently opened, and it's causing those rents to come down quite a bit. Sorry.
That answer really explains your one-word answer to the first question at the beginning about what 2025 was like for Frank DiSalvo.
I felt like I had to expand. Yeah.
I love it. Nathan Coe, I'm coming back to you. Frank brought up development, and this is obviously, S3 Partners, we're ground up development specialists. It's what we concentrate on. How challenging has the wave of development that's happened in store? I mean, we've built almost 100% of the existing square footage in 2015 has been built in the last 10 years. How much of a challenge is that put on the brokerage side of it as you're going to market deals to sell? And yet in many of these markets, there's multiple new facilities in a trade area coming in. What kind of pressure is that put in the market?
Yeah, I mean, immense. I think everyone knows development is challenging, and I think brokers, owners, operators feel it's overdeveloped, yet here we are. We still see new sites coming online. And I think it's not super surprising. I mean, self-storage is a very entrepreneurial business. So they'll never be, in my opinion, like there's going to be more development than people think there should be, just given, again, it's fragmented, it's entrepreneurial. This isn't institutional multifamily that's maybe more focused on the numbers. They're important, but point is there's always going to be that sort of merchant developer come in and think there's an opportunity. So yeah, it's been challenging, and like we talked about a few minutes ago, it's been a lot more challenging in some markets than others. But I don't think it's going to go away anytime soon. It's not like, all right, we had a lot of development the last couple of years, it's going to be off and everything's going to normalize. I think we're going to continue to see that and have experience on the broker side, just like operators on how to overcome that or how long it's going to take to overcome that. And I think it's just going to continue to be a factor.
3 years running, I've been expecting to see a massive dip in the number of net rentable square footage built, and it hasn't happened yet. So
Yeah.
To your point, right? People still feel like building out of the ground. And going back to something you guys said earlier, it's still amazing me, but you're not seeing distressed assets, even if there's things that might have been built in oversaturated markets. Kevin, I'm going to come to you with a question now. You guys have access to information. Obviously, you guys all work for brokerages that are widely recognizable, and you have a ton of data. I want to pivot a little bit to one of the biggest demand drivers for storage that obviously has been very slow now, historically slow for a few years, which is housing movement. Kevin, interested to know if on the Marcus Millichap side, you guys are getting data to give you any insight into what might be happening on that market in 2026, and if we can see any positive news for storage coming out of housing movement.
Yeah, I mean, look, the number of houses in the MLS is very light right now, and inflation has caused housing prices to go up. So it's just been the perfect storm that has hurt self-storage. As these interest rates come down, we are anticipating that will drive more renters and more people selling homes who are sitting in 3 to 4% interest rates right now. It is going to happen. In self-storage, it usually follows the residential market by like 12 to 18 months, right? So we need the residential market to sort of take off first. Once the residential market takes off, then we start to see it in self-storage about 12 months after that. As self-storage brokers and people that advise self-storage owners, my message is just hang tight. Like, it's coming, especially if you have a property that's in lease up. The inventory or the renters are going to come. It's just going to take a little bit of time. I almost feel like I mentioned 2015 earlier. I feel like we're back in 2015, coming out of like 2009, 10, 11, 12, and things are just starting to, I think, break loose. It's going to be slower than what we want it to be. It's going to be a slow climb, I think, back to the top. But these cycles run about every 10 years. We were sort of due for a downturn in the market. It would have been 2009, probably like 2019. We didn't really hit it till the end of 2022. So it's going to come. We're just on the rebound right now.
Frank DiSalvo, you're obviously with Franklin Street, not Marcus and Millichap. Anything different you're hearing on your end?
I think Kevin made a really good point where these storage trends are going to follow the housing
I got to
trends.
stop. There's a reason that your microphone went out. As soon as you said Kevin made a really good point, now I realize why you're muted. I'm kidding. I'm kidding. Sorry to interrupt. Keep going.
Keep going,
I
Frank.
couldn't resist,
Keep
Kevin.
going,
I'm
Frank.
sorry. I couldn't resist.
Keep it going, Frank.
No, I think it's a really good point. And I think a lot of owners are sitting there being like, all right, when interest rates come down, I'll get occupancy back. And I think that's going to occur in primary markets and like premier secondary markets where people actually want to move and will move in the next, year or 2 years when interest rates come down. But they won't, that same effect won't occur in very small tertiary markets, I don't believe. And I think some of this oversupply, some built by Nathan mentioned merchant developers that aren't really looking at all the same metrics. I think that's going to take a really long time to get absorbed, because I don't think when interest rates come down, people are all of a sudden going to start moving to very small markets in the Southeast again. They're going to move to the Austins and the Nashvilles and the Floridas. And I think that's why we see a lot of these major private equity groups targeting those major markets, not the middle of nowhere markets and some of these smaller states or states where the population is declining. So there's got to be a good reason when interest rates come down, somebody's going to move there. And I think that's a really critical point that not a lot of people are talking about. Like it's going to occur, but it's not going to occur across the board in every market in the Southeast.
I love the way you talked about that. And when I break down the development that happened in 21, 22, 23, a lot of it happened in tertiary markets, a bigger percentage that had ever happened in storage before. And are those going to be someone's building a multi-story, 80,000 net rentable square feet in a market with 30,000 people in a 5-mile radius. Hard to wrap your head around why that happened. And are they going to get salvaged by increased movement the same way that somebody in a secondary or primary market will? Likely no. From my perspective, I think maybe we need a little bit of that blood in the water to slow down some of that type of development. Nathan, I'm going to come back to you. I'm going to start wrapping things up now. I want to ask a question as it regards 2026. Do you see this being a market that is better for buyers, better for sellers, sort of even? What's your perspective on what's going to happen in the upcoming year?
I think it's going to get slightly better for both. I think we've been in this challenging time for a few years now, and it's been challenging on both sides. I think if you're a seller, we're not going to be back to those anywhere near those levels we saw 4 years ago. But I do think it's a little, I don't want to say easier, but maybe a little more clear in the markets than it was this time 12, 24 months ago. So I think those people who maybe have wanting to do something and waiting, I don't think it's drastically different. I think there's some opportunity on the sales side, and there's still a lot of capital out there. And on the buyer side, I think it's probably more challenging now than when interest rates were at their lowest, because there's that cap rate to interest rate spread is much smaller, and you have as many buyers bidding on much less inventory. But I also think that there's a little more clarity in what's going on than there was 12, 24 months ago. So maybe that's a cop out, but I think it's going to be slightly better for both this year.
Kevin, any insight on that one?
Yeah, I agree with Nathan. I mean, he's right. It's slightly better for both. He is right about that. It's just, I think what we're seeing more than anything is I'm not seeing quite as many buyers at the table, but the buyers that we're getting are more highly qualified buyers. And I am seeing the cap rates are still getting pushed pretty hard for assets that are larger assets that are, quality assets. We're seeing those on the smaller property, secondary, tertiary markets, not quite as much competition as what we saw in maybe like 2021, 22. But I think we spent the last 2 to 3 years like being creative and trying to make all these deals happen because we couldn't make anything pencil, right? And now we're like actually getting deals done, right? We're getting people to meet in the middle, and that's super important, because that's how we move properties. And in 23, 24, we just weren't closing the gap. It was just so difficult to close the gap between buyers and sellers, and we're starting to have success now. So it feels like we're kind of all meeting in the middle now a little bit more than what we were in the past couple of years. Guys,
really appreciate you all taking the time. I'm going to go through one more round of lightning questions. Try and keep your answer as short as you can. I'm going to start with Frank DiSalvo, fellow Tufts University Jumbo alum. Frank, best cap rates you're seeing primary market?
Best cap, 5.
Nathan?
5.25.
Kevin?
Yeah, 5.25.
All right, let's take that to secondary and tertiary markets, Frank.
It's different. I would say secondary 7, tertiary closer to 8.
Nathan?
We're in 6.5, 7.5.
Love it. Kevin?
Yeah, I'm right with Nathan. Right in that like low 6s, mid 6s on secondary, tertiary 7, low 7s.
Nathan, I want to start this one with you. Biggest lie sellers are still telling themselves as we enter 2026.
Say
That
keep it short.
the cap rates and valuations will get back anywhere near where we were 4 or 5 years ago.
Kevin.
Yeah, the properties are still worth $1 million more than what they should be. I think like we get a lot of those conversations still, right? Still hanging on a little bit to the past, but they've adjusted slightly.
Frank, any different answer than these two guys have given?
Same thing. Yeah, same thing.
Kevin, mistakes you're seeing from buyers right now.
That's a tough one. Man, if you talk to me right now, environmental issues, those are a hot topic. Those are tough to get over right now. We're doing a lot of work in, navigating environmentals. Yeah, it's still coming down a little bit to returns because we're underwriting a lot of things on cap rate. Obviously, that's a big component of it, but we're also underwriting to internal rates of return and stuff like that. And are our projections matching what the operators think that they could do when they buy it? So we're having still a little bit of disconnect between those two things.
Frank, buyer mistakes, are you seeing them, and if so, what are they?
I think staying in touch and kind of just going through some of the motions, which start to feel like motions after a little while if you're in a really tough market, but knowing that, we're going to come out of this and even knowing that, we are finding deals. I think those are the biggest mistakes we see from buyers, going dark, not hearing back. Like that's the difference between finding a deal. Sometimes like, it was priced too high. It's like, well, we sold it for 30% of where we originally had it, but you guys didn't stay in touch. The guys that are getting deals done, I can point to every one of the deals we closed out last year, and there was a lot of resilience from the buyers. And the guys we didn't close deals with did not have the same level of resilience. So that's what I would say.
Nathan Coe.
I agree with that. And I think if it's maybe a mistake, I think there is a follow the leader perception. And in some cases, I do think there's groups being too conservative, and I get why and everything we talked about on this podcast on the challenges. But I think some buyers are just in their own way and they don't want to be maybe the first to step out of the box a little bit. I think there is some great opportunities, and especially even if cap rates don't change too much, where an exit value could be 5 years from now. So I think in some cases, a buyer mistake is to follow the leader too much and maybe get in their own way from a fear perspective.
I'm going to go around the circle with just one last question. Nathan, I'm going to start with you. Any other things you'd add as far as advice to buyers and sellers in the market right now?
Probably similar to what Frank said, just stay in touch. Like you may think you're a seller that knows what your property's worth, and maybe you're right. Maybe even if someone on this podcast tells you otherwise, doesn't change anything, but why not continue to be as in tune as possible? Our industry has so much data, so much out there. I think we're still scratching the surface there with some of the new things that are coming out. So I think just being in touch on a hyper level for buyers and sellers, I think will set people up to do well on both sides.
Kevin Bledsoe, anything final to add?
Yeah, I just think with buyers, I think it's the important part, and Frank brought up a good point. I think just being prepared as the buyer, right? Being prepared, because that happens a lot. We get a number that might work, but the buyer's just not prepared. They have their team assembled to transact quickly. And if they can't transact quickly, we're moving on to the next buyer, because that's what we get paid to do. We get paid to get results for sellers, right? So you got to be prepared or we're going to keep moving.
Frank DiSalvo, fellow Tufts alum, I'm going to finish up with you. Anything that you want to add as we close the segment?
I just think, we have a interesting window here where capital is getting a little less expensive, and a lot of sellers now have debt that's coming due next year, and they're looking to figure out that problem this year before it's too late. And to that point, staying in touch. But I also think the other thing is putting your number down on paper and seeing where it goes. I think a lot of buyers in the past have been like, hey, I'm so far off your number, I don't want to put it down on paper. And if I have an LOI, it is such a huge difference than me just telling the seller, hey, this is what I'm hearing in the field. So now that we have this window that's kind of collapsing, I think, we will see a lot more transactions this year because of this collapsing window. I would really recommend putting that number down on paper. And I think we're going to see better and better deals occur this year, in my opinion.
Nathan Coe, Kevin Bledsoe, Frank DiSalvo, all three of you for the last 40 plus minutes proved exactly why I wanted to have you come join the Brokers Roundtable. Very much appreciate the insight and the time.
Thanks for having us.
Thanks
so much.
Thank you all.
Appreciate all you guys. Nathan brought up something very interesting, which is the access to data that we have going on now. I want to give a shout out to our data partner on the show, Tract IQ. Noah Starr and his team, amazing information that they've added with CMBS data from $40 billion worth of self-storage facilities around the country, 4,000 plus facilities. Shout out to Noah and his team and their endless pursuit of providing the best data so folks can make informed decisions, whether it's acquisitions or ground up development. We're going to finish the show as we always do with the segment of How Faith Fuels Your Business. This is a special one for me this week. James Reed is someone near and dear to my heart. I met him in 2024 at a mastermind. Actually, Frank DiSalvo was at that mastermind also. And James Reed is going to talk about how he integrates his faith with his daily work.
It was like the first time I felt love in life. Like, I think all of us go through a lot of challenging times, and knowing what the Father can do in someone's life and the pure love that he has for us is amazing. I lean into that. I seek that. I want to spend more time with the Father to understand who he is. And as more I understand the love and the grace he has on my life, the more I want to pour into others. God has blessed me in many different ways. He's never left me. And it gives me confidence that I could go out and share more about his love and what faith looks like because of what he's done in my own life. And even when I had that small little lawn care company way back in the day, you know, I always wanted to find a way to get back and let him use my journey, that I don't need to get somewhere to finally be used. His overall message to me over the years was like, James, I can use you right now. You know, we may look good in our suits today, but if we were to take these off, there's a lot of mess behind all this. You know, we may look the part, but there's always something going on in our lives and others' lives. And so when I'm out in the business world, it's the same thing. I think that I view the world as that, you know, how can we help someone? We come into a room, even like the Scott Myers, when I was speaking, I think I just went through a really troubling time in my life. And I just went up and shared my story of what God was doing in my life then. My quick backstory was I lost everything in 2010 to a fire. I lost my house and my business. And that's what ultimately got me into storage, because my friend gave me storage as I was rebuilding my life. And I realized, oh, there's a lot of ways to help someone in storage: death, divorce, loss of a loved one. And there's a lot of money to be made as well. So I'm like, wait, I can help people make money and no longer dig holes for a living. Sign me up. And that's what got me into my real estate journey. Is after I lost my house and my business, even the night that my building was burning down, I just stood there and I was just praying to God that, Lord, I don't know what all this means, but I trust you. It's really easy in this world to play comparison game, but I always go back to my faith in God, that I have the greatest gift that I can ever have, and no one can take that away from me. You can burn my buildings, you can do whatever you want, but you can't take my faith. How are you going to achieve something if you're only going once a week? I always share with my friends, my goal is just to read one chapter a day, because he asks us to be renewed in our mind. And so it's not like this massive goal that we have to accomplish. I'm just using that throughout business, where I give my leadership and team space to share their faith. We pray over the meetings. My full team knows what I believe, but I don't force it. I just want to love on them and provide a space where they can find their faith as well. With being in business, you know, as a business owner, we're able to really steer the ship in a certain way. And I'm thankful that I have the ability to be able to be a little bit of light in this world.
James Reed, shout out to him. Looking forward to seeing him in San Antonio for the SSA in March. We're working on a prayer breakfast. Stay tuned. We're looking like we're going to be able to achieve the goal of getting more than 100 folks, and the SSA is working on getting us on the calendar and a space for that. Very much appreciate Frank and Kevin and Nathan, guys. Thanks so much for the time today. That's it for this episode of Storage Unlocked. I'm Thaddeus Campbell. We'll be back next week.